Welcome to the Bullion Signal Podcast, the channel where we cut through the noise to focus on the signals that truly matter for your wealth and financial future. In the world of finance, sometimes the most significant events don't make the front page. They're buried in footnotes, hidden in technical reports. Today we're uncovering one of those events, a hidden engine that has been quietly turned on, and it's sending shockwaves through the precious metals market. If you want to understand what's really driving gold and silver, you're in the right place.
So let's start with what you can see. If you've been paying any attention to the markets, you've seen gold go on an absolutely historic run. It recently smashed through $4,300 an ounce, a price that would have been unthinkable just a few years ago. This isn't just a small move. It's a paradigm shift, and it's leaving a lot of mainstream analysts scratching their heads, asking what on earth is happening here.
And it is not just a gold story. Gold's more volatile, and arguably more interesting cousin, silver, has also surged, hitting a stunning new high of its own. Now, whenever you see both of these monetary metals move in tandem like this with such force, it's a huge signal. It tells you that this isn't about speculation in one asset. It's a fundamental reevaluation of money itself. A major shift is happening under the surface.
So the real question is, what is that shift? Because these moves are not random. This isn't just market noise or day-to-day volatility. There is a powerful and, for the most part, completely unnoticed decision that is acting as the primary driver behind this entire rally. Today, we're going to pull back the curtain and show you exactly what it is. Okay, so where does this all begin? Well, it all traces back to a seemingly boring announcement from the Federal Reserve on December 10th. And while the media and all the talking heads were focused on one thing, the real story, the one that actually has consequences for your portfolio, was buried deep in the fine print. While the headlines were screaming about a tiny, widely expected cut in interest rates, the truly game-changing piece of information was this. The Fed quietly announced it would begin purchasing $40 billion in Treasury bills every single month. That's nearly $500 billion a year in new stimulus, and it flew almost completely under the radar. So what does purchasing Treasury bills actually mean in plain English? Let's be very clear. This is the central bank creating $40 billion out of thin air with keystrokes on a computer. They then use that newly created money to buy up government debt. You need to think of this less like shuffling existing money around and more like opening a brand new massive fire hose of cash and pointing it directly at the heart of the financial system. Now this is where it gets really interesting. You have to pay close attention to the language they use. The Fed has learned over the years that the phrase quantitative easing, or QE, really spooks the public and the markets. It sounds like what it is, money printing. So they've quietly rebranded it. They now call it reserve management or technical balance sheet operations. But make no mistake, a rose by any other name is still a rose. The name has changed, but the effect, massive expansion of the money supply, is exactly the same.
Now, the reason this is so important is that this isn't just some abstract economic theory. We don't have to guess what's going to happen next. We have a very clear historical playbook for what happens when the Fed turns on the printing presses like this. As the saying goes, history doesn't repeat, but it certainly rhymes. And we've seen this movie play out multiple times before. Just look at the timeline. From the very first round of QE back in 2008 after the financial crisis, to QE2, QE3, and of course the unlimited QE we saw during the COVID pandemic, each and every time the Federal Reserve has launched a program like this new one, the reaction in the gold and silver markets has been remarkably consistent and, frankly, quite predictable. And the historical pattern is just undeniable. The numbers speak for themselves. During the first QE program, gold jumped 75% and silver 90%. After the COVID stimulus, gold rallied 38%, but silver rocketed an incredible 150%. The data tells a very clear and unambiguous story. When the Fed creates money, the value of precious metals has historically responded with significant gains, and very often it's silver that leads the charge with explosive moves.
Okay, So we've established the what, the Fed is printing again, and historically that's been rocket fuel for metals. Now let's get into the why. What is the actual economic transmission mechanism here? Why does creating more US dollars cause the price of a lump of gold or a bar of silver to rise so dramatically?
Well, it really boils down to three fundamental economic forces that all work together. And what makes this particular moment in time so potentially explosive is that all three of these powerful mechanisms are being triggered at the exact same time. The first one is the most straightforward: dollar debasement. It's simple supply and demand. If you flood the world with trillions of new dollars, each individual dollar in your pocket, in your bank account, is worth less. It buys less gasoline, less food, less everything. But gold and silver? Their supply is finite. You can't print them into existence, so they act as an anchor, holding their purchasing power as the value of the currency around them sinks. Second, and this is crucial, is inflation expectations. You see, smart money, institutional money, doesn't wait for inflation to show up at the grocery store. They see the cause, the money supply expanding, and they immediately begin to anticipate the effect, which is future price increases. So they act preemptively. They move their capital out of cash and into hard assets, real things, and gold and silver are the world's oldest and most trusted hedges against inflation. And finally, there's the concept of lower opportunity cost. Think about it like this. If you can put your money in a government bond and earn a safe 5% interest, you might hesitate to buy gold, which pays you no interest at all. The 5% you give up is the opportunity cost. But when the Fed's actions push interest rates down towards zero, that cost disappears. Suddenly, holding a non-yielding, real asset like gold becomes a much more attractive and logical choice compared to holding a bond that pays you next to nothing. And listen, this isn't just our analysis here at Bullion Signal. The biggest players on Wall Street are seeing the exact same thing. Goldman Sachs recently came out and publicly raised their price target for gold to nearly $5,000 an ounce. And what was their reasoning? They specifically cited these very same monetary factors. When the smart money starts making moves this big, it's time to pay attention. Now here is the most crucial point of this whole analysis, and it's what makes today's situation so unique. The Fed's massive injection of new money is not happening in a vacuum. It is colliding head-on with a fundamental, structural, and historic squeeze on the physical supply of these metals. This is where the story gets really compelling. I want you to think of it as a perfect storm. The Fed's money printing is the gasoline being poured on a fire, but that fire was already burning hot. Why? Because we have record industrial demand from new technologies, mine supply that simply cannot keep up, rapidly shrinking stockpiles, and central banks around the world buying gold at a pace we have never seen before in modern history. Now, if you think the monetary side of this equation is dramatic, just take a look at the physical supply side, specifically for silver. This chart is absolutely staggering. Back in 1980, the world had about 4 billion ounces of silver in known above-ground inventories. Today, we have less than 1 billion ounces left. Let that sink in for a moment. In just over 4 decades, humanity has consumed 75% of the world's known silver stockpile, and most of it is gone for good. And this isn't some abstract problem for the future. The supply situation is so tight, it's happening right now. Even the United States government is struggling. The U.S. Mint, the institution responsible for producing the famous American silver eagle coins, recently had to suspend production. And what was their official reason? Unprecedented demand and supply chain constraints. They literally could not get their hands on enough physical silver to meet public demand. And here is the single most important thing you need to understand about silver that makes it different from gold. Unlike gold, where most of it is held as jewelry or investment bars, over half of all silver, 55%, is consumed by industry. It's an absolutely irreplaceable component in the technologies that are building our future: electric vehicles, solar panels, 5G networks, AI data centers. And here's the kicker. Once a tiny bit of silver is used in a microchip or a solar cell, it is gone forever. It is simply not economical to recycle it. It gets used up and disappears from the available supply.
So let's just put all the pieces together and recap what we've learned. You have the Federal Reserve turning on the spigots, injecting billions of new dollars into the system every month, a move that history shows almost always acts as a powerful catalyst for precious metals. At the exact same time, this new wave of money is chasing a physical supply of metal, especially silver, that is shrinking to critically low levels. It is the absolute classic textbook definition of more and more money chasing fewer and fewer goods.
So all of this brings us to the final critical question that you should be asking yourself. With these incredibly powerful forces converging, unprecedented currency creation on one side, and a historic structural supply squeeze on the other, we have to ask, are we simply watching another market cycle, or are we watching the entire financial playbook get rewritten right before our very eyes? That's the question we'll continue to explore here on the Bullion Signal Podcast. Thank you for joining us today. If you found this analysis valuable, please consider liking this, sharing it with someone who needs to hear it, and subscribing to the channel so you don't miss our future updates. Now, a quick disclaimer. The content in this podcast is for informational and educational purposes only. It is not intended to be and should not be construed as financial or investment advice. You should always conduct your own research and consult with a qualified financial professional before making any investment decisions. You are solely responsible for the decisions you make.